Welcome to A Strategic Approach to Managing Deal Risk. This session is presented by Aon and Wipfli. Let's meet our panel. First, welcome Allison Coyne, Managing Director and Chief Broking Officer, Aon. Next, welcome David Bernstein, Principal and Owner of RLS Associates. Finally, welcome Michael Vaccarella, Partner in the Private Equity and Transaction Advisory Practices of Wipfli. And moderating today's conversation is Jack Reich, Managing Director of Aon. Jack, take it away.
Good afternoon, and thanks for joining us today. My name is Jack Reich, and I'm a Managing Director with Aon in Philadelphia, where I lead client development. It's my privilege to serve as the moderator today, and we've prepared a great panel of executives who will share their experiences on how to minimize and manage deal risk. So I'd like to dive right into the discussion, but first, we'll give each of the panelists an opportunity to introduce themselves. So with that, Michael, would you please kick it off for us?
Sure, happy to. Michael Vaccarella, I am a partner at Wipfli LLP, which is a top 20 CPA firm headquartered in Milwaukee with offices across the country, including Philadelphia. I lead our transaction advisory services practice nationally, and we are excited to have a little discussion here on the QV side.
Thanks so much, Michael. Allison, to my colleague, Allison, you're up next.
Thanks, Jack. Allison Coyne. I am Managing Director, Chief Broking Administrative Officer for our Transaction Solutions team. We are a team of 40 professionals throughout the country. I'm based outside of Philly, focused on insurance solutions to help facilitate M&A deals. I've been in the reps and warranties insurance market for almost 21 years, so excited to provide some perspective and enjoy this discussion today.
Thanks, Allison. David, please close us out.
Thank you very much. I'm David Bernstein with RLS Associates. We're headquartered in Wilmington, Delaware. We're a mergers and acquisitions advisory firm. I've been with the company since December of '88. We've been around a little longer than me. And we work with all kinds of companies, manufacturing services, et cetera. The size range is generally in the under $100 million range. But on the buy side of what we do, we also work with some much larger companies as well.
Thanks, David. So as we look at and talk about deal risk, I guess the first thing that comes to mind is, what are some of the ways that we can early on in a deal recognize potential risks? So that I'll kick that off to the panel. Michael, would you like to take the first crack at that?
Sure. Early on, I would say, from both buyer and seller, we hope that typically a seller would be doing a sell side Q of E, which has become a lot more customary, although very time crunched in this current environment that we're in, and that's going to hopefully ferret out some ins and outs that are difficult for a buyer to get their arms around, so that seller can kind of hedge that off sooner. A buyer, obviously from their perspective, they're going to want to get in and get as much information as they can around the CIM in the deal flow. From that perspective, and getting their Q of E teams kind of lined up, early on. It's just been amazing with what's going on in this last year for the time crunch perspective, and we think that's only going to continue through the next couple months. So.
Great, thank you. Allison, thoughts?
Yeah, I'd say, just on the timing and getting, prepared to dive into a deal, to think about fairly early on what the scope of indemnification will be regarding reps and warranties insurance. Will seller be indemnifying? Will there be an escrow? Or will this be a deal utilizing reps and warranties insurance? The market right now is extremely overwhelmed with deal volume. Lots of deals looking to get done using reps and warranties insurance, which is fantastic, but we're seeing unprecedented deal volume. So to buyers and sellers who are beginning to engage in the deal, I'd recommend thinking about insurance on the early side, preparing in advance, to understand whether insurance is going to be needed, and leaving some additional time to secure quotes and get comfortable with the terms and conditions that are going to be available from the insurance market. I think that's something that I couldn't underscore more strongly.
Thanks, Allison. Thoughts from you, David?
Well, I certainly agree with Michael. A Q of E, if the seller's willing to do it early on, is a tremendous asset to someone in my position. It highlights where the issues are. It can often allow us to pre-answer questions that may be raised by a buyer, to structure deals around objections that are likely. Unfortunately, a lot of our clients don't yet do that, and we certainly would recommend they do so. But a lot of them are fee sensitive for one reason or another. If they have not done a Q of E, what we do on our end is we do our own analysis, a common size analysis of the company, looking at trends in expense line items, revenue line items. We ask about things like revenue recognition, but it's nowhere near the detail that a firm like Michael's would do in a full Q of E. But a lot of people go out to market without asking any of these questions. And it's a huge mistake.
I have a question, David and Michael, just for my own edification. We're starting to see more deals with sell-side Q of Es, particularly when target companies have unaudited financials, which is extremely useful, I think, on the reps and warranty side, where there isn't an audited or even reviewed or financials to see that there's a sell-side Q of E. Of course, buyers got to do their own financial diligence and test the work that's done in that Q of E. But I'm wondering, are these largely target companies without audited financials that you see using sell-side Q of E more regularly, or is it expanding beyond that?
I can jump in quickly on that. It's, I look at it, majority of them, the investment bank that may be repping the deal or bringing that to market is always a little more leery when it's not an audited statement. So the sell-side Q of E becomes very important. We've seen quite a few actually we've done that have audited financials, that still want a kind of a trust but verify situation. Everybody knows and being a reformed auditor, I can speak to it. Audits don't always have the same framework catch as what would be in a quality of earnings. It's definitely more balance sheet driven from an audit perspective. So there are a considerable amount of add back verification that goes on and kind of doing that. Now, big caveat, obviously, for all the buyers out there, the seller Q of E, they're not independent of that that seller. So they're on their team. So there's definitely a little bit of a stretch in things that get done, around add backs and things that are looked at. So we want to keep everybody kind of on their toes, and obviously that's why a buyer would still do their own Q of E to kind of vet those pieces. But the overall, I would say for the most part, it's a lot of times it's under audited companies that are definitely the ones using a sell side Q of E for comfort.
Another time where you might see it is if the company has changed accounting firms recently.
Mm-hmm.
So if they only have 1 year of history of audits or 1 year of history of audits with this particular firm, a Q of E might be a good way to bridge that gap to give some more comfort, particularly if they'd been with a smaller or less well-known firm before.
Thanks. So there's a lot to manage in the process. So when we look at it from whether it's Q of E or reps and warranties, each deal has its own rhythm and its own cycle, but clearly, acting with speed and being fastidious in the information that we look at is critical. So keeping all that on a timeline can be a challenge, but we've seen it, and we all recognize how important that is. So talk a little bit about that, and then also, if you could give an example or two of when see maybe there's downside when there's lack of preparation, and perhaps if there's a story where you've been able to get involved late in the process on a deal that could have used you or some other eyes earlier in the process where you got to the right spot being brought in. But hindsight 2020, what does that timing look like?
Sure, I'm happy to jump in. From
Sure.
I think networking capital tends to be the biggest sticking point you could possibly have in a deal, and you see some things that get worked out early, and those deals tend to tend to be a little smoother. Although if they try to work something out early on in the process before a Q of E, and then the Q of E comes in very much different in a net working capital kind of a threshold or a peg, then everything gets tossed into a kind of a tornado downward spiral spin that gets a little crazy. But I think the working capital for me typically ends up being the most arbitrated thing that it can be done. So getting that kind of out of the way early, telling your QOV firm to focus on that early on is important, because I think that's always a big linchpin for the purchase agreements. And it's honestly most sellers just don't understand the concept well enough to if a number gets put in an LOI, they kind of stick to that number. It's hard for them to get away from that. So, getting your arms around that sooner than later is definitely by far. And we've jumped into situations late where we've had to explain, normal working capital is a little different, especially in a cyclical or a seasonal business. The amount of discussions that go around that, and if we bought the company in September right now, we're going to be well up over the peg. If we bought it in October, more than likely it's going to be way under. Does that really change the value of the company, or is that still normal? So a lot to be discussed and go forward with. So I would say net working capital is a big one.
Yeah, I agree. Net working capital is a huge issue. In fact, we will often require that either it be resolved before exclusivity or shortly thereafter in terms of the due diligence period. And in fact, I'm working on a deal right now where I am doing a net working capital calculation for the buyer on their methodology with our client's data to make sure we're all on the same definitional and mathematical page. Now, that number could change during QOV. Everyone knows that if it's found that there was an error in the source data, but the methodology is agreed, the math is agreed, and the metrics and inclusions and exclusions are agreed. So that helps foreclose some of those last minute surprises.
So from my side, from the insurance side, as I mentioned earlier, thinking through whether or not reps and warranties insurance is going to be needed for a deal, whether there's going to be seller indemnity or escrow is something I think need to sort of sort out early on in the process. So parties are agreed, one on value, whether there's going to be any holdbacks, or whether insurance is going to sort of step in the shoes on, and replace the seller indemnity. I think, we certainly are accustomed to working on fire drills and moving really quickly and sort of getting those last minute phone calls and being able to get the insurance in place to allow the deal to sign or close. But the sooner that the parties, determine that insurance is going to be needed, the better. That way, that the underwriting process and quoting process sort of moves in lockstep with the deal timing, and there's no sort of lag or hurdles to get over the line on the eve of signing or closing. So early preparation on that part, I think, is helpful and allows the parties to really negotiate and understand sort of how they're allocating risk and not leaving any hurdles or challenges to deal with later on.
Yeah, we closed the deal on December 31st of last year. I can tell you the RWI made that deal happen. Now, the buyer's counsel was experienced in RWI, but the buyer was not. And that was a bit of an issue for us. But the existence of it made the deal work for the seller. Without it, it wouldn't have happened.
Yeah, there are, it's becoming more and more sort of a crucial piece of sort of the deal process. 20 years ago, that reps and warranties insurance wasn't used very often. It was new, and now it's become sort of normal course. But there are, as you mentioned, buyers out there who are still new to the process, new to the concept of reps and warranties insurance. So there needs to be some hand holding and education. But I think the market is certainly convinced and encouraged, buyers who may be used to and prefer indemnification to really embrace and get comfortable with reps and warranties insurance, because it's here to stay.
Yeah, and Allison, I would reiterate too on the importance of the RWI. I think it's held, accounting firms, Q of E's feet to the fire a little bit closer for sure than I think what's happened in the past. And then I think it's definitely made things more transparent, more honest going forward. So we've enjoyed working on the deals that actually have gone and went for reps and warranties, because it's quite honestly, it's just everything's getting looked at 2 and 3 times over.
Yeah.
And the scrutiny, I think, is well needed in some of these larger transactions as well. So
That's really comforting to hear, because the questions and the follow-up and the scrutiny that the underwriters perform, sometimes it can be challenging to sort of navigate when you're dealing with trying to get a deal done and diligence, and then you've got questions from an insurer. But in many cases, it is that extra pair of eyes that can spot issues and bring things to the fore that I think can often be helpful in helping to sort of help allocate risk and make sure the parties sort of understand what they're buying, and negotiate accordingly.
Yeah, I would agree.
So we've hit on a number of elements of deal risk, but let's talk about, how does due diligence play into managing and minimizing deal risk?
That sounds like it's coming at me first, so that's fine. I think due diligence, that honestly, that trust but verify situation that we all work in, it's really a concept that I think many a times there's a lot of firms out there, there's a lot of companies that will do their diligence. We'll call it it's done diligence, not due diligence. It's like, okay, we just need a rubber stamp. We know where we're at. We like the operation. Let's just go get this done. And that's where with the RWI coming involved, it sets up more than that. It's not just done diligence. You got to go out and do your due diligence and get to the point where everything is known. We'll go the known unknowns and the unknown unknowns and all those things that have to get kind of verified through. But the real concept to me is matching up the operational diligence and why the buyer really likes the company to what the accounting really says, and then, kind of just go one step further, go see what the tax returns say at that point too. So even if you're not doing a stock deal, it's just a matter of, is that those level of checks going through and all those stories jiving together to make it one, kind of cohesive, verification that gets done.
Mhm.
But I would, yeah, without a doubt. Go ahead, Allison.
No, sorry to talk over to you. No, I think it's really important to underscore sort of the sensitivity and connection that the buyer's diligence has to the outcome of the reps and warranties insurance process and the scope of coverage. The underwriters do not do their own first-party diligence. They really piggyback off the work that the buyer and their advisors do for that particular deal, and they're really looking to get comfortable that the scope and level of diligence sort of pairs up nicely with the scope of the reps and warranties that are being given that describe the business that is being acquired. And so when you talk about sort of done diligence, it probably sends shivers down underwriters' spines, because they want to make sure that it's truly due diligence, thorough diligence, because they're, in many cases, the only sort of financial security standing behind the accuracy of those reps and warranties. And so they want to make sure that the buyer is doing the work that gets them comfortable that the reps and warranties as are negotiated are correct, at least to everyone's knowledge. And so, where due diligence is sort of, gone through in a quicker or more limited way, that can impact sort of the scope of coverage. And so it's important to sort of understand that connection. And to the extent there are any known material risks, those likely give rise to exclusions, but are typically those kinds of things that buyers and sellers would be negotiating standalone indemnities for anyway. But I can't, it's important for the parties to understand, particularly the buyer, how important that diligence process is to a good and successful outcome on the insurance side.
And on the sell side of it, as we do buy side work as well, but on the sell side of it, we view due diligence as a chance to really get everything on the table. We try to do it before due diligence because we'd rather not have any surprises during. But we always tell the seller the same thing: disclose, disclose, disclose. Anything get it on the table early and not just once. Because what we don't want is later on for someone, whether it's an RWI company or it's a lender or someone reading this who's not already in love with the deal to all of a sudden find out something that wasn't baked in up front. So we get it out early and often, and due diligence is a weapon for the seller as well as for the buyer. Just the seller, it feels like they're getting a colonoscopy every day for 6 days. But for the buyer, they need to be comfortable, and the seller really has the chance to get everything out there they possibly can know of.
Yeah. I did not get my doctorate in that.
I don't blame you. That wouldn't be my case, but nonetheless, it really is. It's a very, it's a very detailed, long, and intrusive process. But at the end of the day, if the company is well run, it's well run.
Yeah.
And you can generally negotiate around anything you find as long as it's disclosed. What costs you money is undisclosed liabilities. Someone's going to get hurt. Someone's going to sue. That's not what we want. So we're big sticklers on anything we know, anything the seller's hinted at, get it out early and often.
Yeah, and then the reps and warranties insurance is there to cover those unknowns. You can do your diligence, you can look over under every stone, but you only know what you know. You don't know what you don't know, and that's where the insurance steps in to cover the unknown. And that's what's the appropriate sort of allocation of risk. The parties have done their work; they've done everything they can do to get comfortable, and the insurance is there to pick up the unknown.
Right.
So let's talk a little bit about the reps and warranties piece of it. We've talked on due diligence and the relation that it plays in a reps and warranties process. But whether it's a buyer or seller, what are some of the benefits of the reps and warranties insurance? And then what might be some impediments, or why might some buyers or sellers have reluctance to getting involved with looking at a reps and warranties insurance product?
So I'll start with benefits, and I'll start with sellers because it's easy and obvious. It's the ability to avoid indemnities and escrows and walk away with more cash in their pockets at closing without the worry that a buyer is going to knock on their door months, years after closing and with a claim and asking to be compensated for loss. The ability to have buyers look to insurance in lieu of a seller indemnity and to supplement a much reduced seller indemnity or escrow is really quite valuable to sellers to get that certainty and to walk away with more proceeds. Particularly if you're a private equity seller, you can distribute those proceeds to investors, or if you're just a founder or otherwise not a non-financial seller, to be able to use those proceeds and do other things with them. For a buyer, the benefits, I think, in this market are really to be able to be successful in executing on deals and being able to be competitive in auctions, because in this environment, many deals sellers are expecting or encouraging or even requiring the use of reps and warranties insurance in lieu of traditional indemnification. So the benefits to a buyer are being comfortable and being able to deploy reps and warranties insurance is going to help that buyer execute their M&A strategy, be successful in winning deals. But it's not also not only remaining relevant and competitive in this market, but also having another tool at your disposal if you encounter a seller who is unable or unwilling. Sellers in financial distress. Companies that are held by ESOPs. There are certain situations where it may not be the market dictating the use of insurance, but it may be the seller itself just not being able to or unwilling to provide indemnification. So insurance is a benefit to sort of bridge the gap on those deals. Otherwise, a couple important points to understand about the value of insurance versus an indemnity is, with an insurance policy, buyers can get long policy terms, 3-6 years. Compare that to, a survival period of maybe 18-24 months at most. Buyers are going to get more time to make a claim under the policy than they would be able to negotiate with the seller. Also, as far as the quantum of coverage, that's really at the buyer's discretion. Many sellers, when you're negotiating an indemnity or escrow, you're expecting 10 to 15% of deal value. For the policy, that's a very common amount for limits, but you're not constrained. Buyers can buy up to full purchase price if they wish. So you can seek sort of a longer period of time to get coverage, as well as sort of a greater dollar amount of coverage in the policy. Downsides, it's hard to really think of any downsides for sellers other than you need to, sort of incorporate in the timeline the expectation that insurance is going to be used. And it could, as we talked about, with the diligence, you're going to have another party sort of reviewing buyer's diligence. There's always, additional follow-up questions. So there could be sort of more inquiry coming through from the buy side to seller, questions that need to be answered. But otherwise, for sellers, the weight is really on the benefit side. For buyers, I guess the downside is to understand that there will be certain exclusions in the reps and warranties policy that aren't necessarily present when you've got a seller indemnity. One is, the actual knowledge exclusion. If there are breaches of which the buyer deal team has actual knowledge of and the date the policy is put in place, those are going to be excluded. You don't necessarily have that kind of, not always have that anti-sandbagging type concept in the agreement itself. Another area are those deal-specific exclusions. So we talked about how sensitive the underwriting process is to the scope of diligence. To the extent that there are any known material issues that are discovered in diligence, those could give rise to very specific, tailored deal-specific exclusions that you wouldn't necessarily have if you were negotiating with a seller. Often, depending on the dynamics of the deal and the negotiations with seller, buyers might be able to have sellers sort of step in and indemnify for those specific deal exclusions. But that is a landscape, that is a nuance to be aware of when you're a buyer of something just to get comfortable with. So those are sort of the benefits and downsides. I think overall, buyers, sellers, advisors have really embraced sort of the value of reps and warranties insurance in the current deal environment, and seeing an extraordinary amount of deals utilizing it.
I think one of the things is that if the buyer is going to pursue it, they should start pursuing it earlier rather than later. That's one of the things where I think we've seen the less sophisticated buyers. It's extended some timelines, and they could lose a deal over some of them, particularly with the tax timing that's happening now.
Yeah, I completely agree. In the current environment where there's such a high degree of deals in the market, insurers are being fairly picky on what deals they're quoting. They're trying to manage their bandwidth, and if it's a challenging deal, unaudited financials, multiple jurisdictions, highly regulated industry, if you've got all these things sort of swirling around in your deal, start early because it takes a lot more legwork these days to get insurers to the table to quote. They're looking for ways to sort of manage sort of their deal flow. So you certainly want to start early. Small deals have gotten a little bit more challenging, although there are some markets who that's squarely within their sort of strategies to be to execute on small deals. So you just need to prepare, the sooner the better, and leave some more time on the front end to get quotes and understand what's available. The underwriting process has not really been impeded. I mean, that moves, once an insurer is in, that moves in the typical way, and we're not seeing any impacts as far as timing, but you do need to leave some more time on the front end when you're looking to obtain quotes.
Right.
You hit on some examples, but if you could elaborate for the panel on, how and when and why do we use or not use reps and warranties policies and deals? What are some of those elements that we maybe haven't touched on at this point?
So I think we've touched on many of them. In competitive deal situations, it's often going to be the seller who's expecting or requiring reps and warranties insurance. In the past, buyers used it as a way to differentiate themselves in a competitive situation where they may be the only bidder using reps and warranties insurance and able to offer very low indemnification or none at all to seller. And that was a very successful strategy. Now, it's no longer a differentiator. It's just, it's almost, being able to level the playing field. If you're not using reps and warranties insurance in a competitive auction, you're likely not to be competitive. Other situations, we talked about financial distress. We've talked about unique types of sellers like ESOPs. Other areas where we're starting to see reps and warranty insurance being used are secondary deals. Also, sort of this, not to bring up SPACs, but that's been a popular topic over the last year. But those de-SPAC transactions where the SPACs identify the target are transactions that are using reps and warranties insurance. So there are some unique areas where reps and warranties insurance is being used. And it is continuing to move sort of lower and lower to pick up smaller and smaller deals. Although I would say in this market, those are getting a little bit tougher to do, just given how insurers are trying to manage their time and bandwidth. But so small deals, you want to understand economics and feasibility for sure. If you're looking at 50 million EV or lower, you definitely want to test the market, get some feedback from your broker. And then very big deals, we have about $1 billion to $1.3 billion of insurance available for a deal, so we're able to execute on very large deals. But some of the deals you see in the headlines may just be too big. You want to factor in sort of the available capacity, but we're continuing to expand and be able to execute on just bigger deals.
Yeah, Allison, I was gonna ask you if you wanted to chime in too about, we're fearful of a little bit of nakedness in deals going to be happening in the next 3 months before, as things want to get closed, and sellers rushing to market, buyers want to get, capital deployed, and I'm wondering if you're anticipating a little bit more claims to be pushed through or that piece, because, as much diligence is getting done, the time crunch has been just unreal. And I don't expect it to get any better. So I was curious if you're bracing for that.
It's so funny. I just had a conference call just before this one where we were talking about that exact scenario where this year's been crazy. The number of deals getting done. There's still this pent up energy and just forced to get deals across the line. And I think underwriters are still being very good, being very diligent about underwriting, making sure that the diligence being done is good. To the extent that there are gaps or issues, you're going to see that in the coverage position. But for sure, I think over the next year, we're going to brace ourselves for some claims. I mean, it's expected as you see the volume of deals increase that are using policies, using insurance. You're going to see more claims, just probabilities. Over the years, it's hovered around sort of an average of around 20% of the deals that we place insurance for give rise to a claim. Not all of those actually involve loss that pierce the policy retention, but that's remained somewhat steady. We do see increasing amounts of loss that are being sought under these claims. So certainly magnitude is something that we're keeping an eye on. And just the environment, particularly COVID's been an interesting one, is, these policies are assets, there's cash. And so, if companies are looking to find, pockets of cash to help, their operations and keep things afloat, these policies are there. And so we definitely saw a trend where pre-COVID claims were sort of, moving along sort of at a slower pace. But once COVID hit, we saw clients really focus on open claims and say, how can we move these forward to the finish line? So that's been an interesting dynamic.
Allison, if we could talk a bit about tax and its role in reps and warranties insurance and transaction liability.
Sure. So I will confess I'm not a tax lawyer, so I know enough to be dangerous, but we do have a tax team as part of our transaction solutions team. We're all former tax attorneys who are focused on tax insurance. But definitely, a solution to be aware of, buyers and sellers and advisors should understand is available. We talked about reps and warranties insurance being the solution for sort of the things that parties don't know about, for the unknown risks. Tax insurance is a bit different. It is there to cover sort of known potential tax liabilities. So, it more often comes up in the M&A context if a buyer is doing tax diligence and there's a material tax liability that they've uncovered and that they're uncomfortable sort of taking on, maybe sellers not willing to indemnify or provide an escrow for that particular tax issue. So tax insurance can be used to sort of put a box around, ensure that particular known tax issue, avoid having seller to indemnify, give comfort to the buyer that there is insurance there to pay the ultimate tax bill if the IRS audits and makes an assessment, pay the tax bill, contest costs, fines, penalties, even a gross up. So it's a very useful solution to the extent there's a material known tax issue. Or if there are sort of tax advantages or benefits that the buyer has attributed some value to, the easy one that I often think of are net operating losses. If there's significant NOLs, the availability and usability and amount of NOLs are often, excluded from the reps and warranties policy. So if the buyer is ascribing some value to the use of NOLs in the future, that is definitely something to look to tax insurance for. So that's an example of not necessarily a tax liability, but an asset that the buyer wants to make sure that's going to be there for them. They understand that the amount is what it is, and it's going to be available for their use. So, but the easy way to think of it is, known tax risk or known tax sort of benefits. Look, if there are material ones that the parties are concerned about, tax insurance is the solution to sort of bridge that gap. And I should actually make the point that it's, we're all talking about M&A deals, but tax insurance is a solution that can be used outside the context of an M&A deal, for clients' own corporate tax planning purposes. Tax insurance is useful. It doesn't necessarily have to be a deal.
Thanks, Allison. Let's turn back to quality of earnings for a moment. We talked about its role in due diligence and in general terms about managing deal risk. But Michael, could you talk to us a little bit about the benefits of a quality earnings process report for a buyer and a seller?
Yeah, sure. From a buyer perspective, I think that's probably the easier pitch. Whether the buyer one needs it for the bank, needs it for their RWI. Those positions. It's kind of I'll say it's customary at this point. That it's yes, they're gonna ferret it out. My QV firm's gonna ferret out. Any major seller add backs that are quote unquote garbage at that point, and work through, how we reiterate the deal. But on the sell side, I think there's still a fair amount of, and David, the investment banks are definitely, pulling us in more and more and earlier now, to kind of get those done, which is great. But I think the sellers still have a little bit of a, reluctance to do that, because they're like, well, especially with an audited, with audited financials, like, well, I get an audit every year. This is fine. And it's not the same. And one of the highlights I would say, we did a deal, pretty large, roofing manufacturer that, really, was a little bit reluctant, but wanted something, to kind of put a stamp on it. And frankly, the work that we did, to help him ferret out kind of what his steel suppliers were doing to him and some of the defective steel he was getting, and the deal stretched on for about 6 months. This was kind of just shy of pre-COVID. We actually put like $6 million back in his pocket because we showed him how one of his steel manufacturers was just crushing him. So in that perspective, so if you have time on your hands, it's or at your side, it's helpful to be able to get a real operational and accounting look. But in some of these cases now where we're dealing with a time crunch, I can understand where sellers are like, well, I don't need it. My investment bank did this for us. I've got audits, we're okay. But there's still speed in the deal that happens when you have a Q of E, because it just starts the process earlier. Your buyers can come in, grab, and most of the Q of E firms that are doing sell side are willing to share their data book and the amount of work they did, which saves the buy side, a ton of time, getting their arms around a deal. And speed right now is imperative. So, I think that's continuing to put the seller saying, work to get this done. It's just paramount at this point. So, but there's benefits financially from a cash position pre-deal that can be done with a sell side QB. And, I'll stick to those guns any day. So.
It also can help with companies that don't have very well-established internal accounting processes, where this sort of, maybe for many years they haven't invested in the software and the staff they should have to keep those things right. The Q of E report can make up for some of those past sins, and or highlight issues that need to be fixed before you go to market. The worst time to have a problem arise is after you've signed letter of intent.
Right.
The bargaining power has all shifted from seller to buyer at that point. Whereas if you get it out earlier, that's when you have the strength, particularly in a competitive process, to negotiate and get the deal you want despite whatever flaws you have.
So when is the right time to kick off that engagement? Clearly not after the LOE, right? But when, at what point would you recommend that engagement gets kicked off?
With the Q of E engagement?
QV.
For seller or for buyer. If you're a buyer, you would not want to do it until you have the deal pretty well sewn up, and know it's pretty much your company. If you're the seller, it's almost a prophylactic, way to do it, to find out if you're going to have problems. So the earlier, the better. Now, that being said, a lot of sellers are so fee sensitive, they won't do it, particularly in smaller deals. It's just a reality in my world. But I'd say the earlier, the better.
Well, it looks like we're getting up against time. So thank you to this great panel for your insights and thoughts on this. But before we part, any last thoughts? We'll start with Michael.
Sure. I think looking back to across the RWI space and the Q of E, I think we tell all of our clients, revenue is vanity, profit is sanity, and cash is king. Let the diligence ferret that out, and RWI will go a heck of a lot smoother. So that's how I'd finish. So
excellent. And so
Thanks.
just
Allison?
to touch on that, yeah. So fourth quarter is looking to be extremely busy. Think about insurance is one of the first things, not one of the last things. So we're there for you, and the insurance is there for signing or closing.
I primarily tell people that a buyer is buying sustainable transferable profitability, STP. And seller's job is to make sure that they engineer their companies so that they get a buyer comfortable that the profits they're selling them are sustainable without them, the seller, are transferable to the buyer, and will be at least as good or better in the future as they were in the past. The way to do that is to be straightforward and disclose. Get it all out there on the table, and engineer your company to be financially and operationally strong and sound and strategically differentiated.
Well, thank you, David. I think that's a great summary for our discussion today. And thank you, Michael, and thank you, Allison. It was certainly a productive and lively discussion, so thank you for your contributions. I hope everyone who's joined us today will join us for the following session, and we'll open it up for some questions and answers. Thank you all.